Hello and welcome to the UK SIF's Leadership Podcast. I'm really pleased to be joined today by Jess Henry. We'll be talking about how short selling and derivatives can be used to drive forward a sustainable financial sector. Jess is a senior research analyst within Man Group's responsible investment team, where she works across the firm's different investment engines to embed ESG concepts into strategies. Jess has been with Man Group's RI team for 2 years, with a previous focus on net zero and more recently leading the firm's biodiversity research efforts. Man Group is a global active investment management firm with a number of alternative products, so Jess has experience applying ESG concepts to alternatives, particularly in the hedge fund and systematic space. Last but definitely not least, Jess is also a very active member of the UK SIF's Industry Development Committee. Jess, thank you so much for joining me.
Thanks, Sally. Really excited to be here.
So we'll just sort of dive straight into the discussion here. We're seeing massive traction in the sustainability within alternatives. We ourselves host our Alternative Investment Week every year. A little shout out for the listeners. The conference will be taking place next week on the 22nd of June in London. But every year we are seeing that it's growing rapidly. I think we've doubled in size since year one. We've of course seen this growth of interest in sustainability in other financial products, mainly the sort of publicly listed long-only equities. So why do you think that the hedge fund products like short selling and derivatives have been ignored as sustainable investment tools for so long?
Yeah, so I think there are a number of reasons. So firstly, the more complex nature of hedge funds in comparison to, say, long only, both in terms of the types of strategies, but also the asset classes that might be traded in hedge fund products. And when you think about it, it's taken the industry literally years to develop and define industry standards and frameworks for ESG for relatively simpler asset classes like listed corporate equities and bonds. And there's obviously still tons of ongoing work to consolidate frameworks in these areas. So for me, it's not really that surprising that alternative strategies, which might be using short selling, complex derivative instruments, and also systematic multi-asset strategies, it's not really that surprising that they've essentially been ignored up until quite recently. And it's not as straightforward as simply applying the frameworks that have worked in the long-only space to alternatives, because there are lots of nuanced and potentially contentious points that will need to be addressed specifically for hedge funds. And of course, as with any area of ESG, we'll need to strike a balance between defining standards that are going to help investors, but at the same time not being so prescriptive that we start to stifle innovation in terms of the types of ESG approaches that can be taken. So definitely the complex nature of hedge fund products, but I think also the natural disposition for opaqueness, particularly on the short side, might have prevented sustainable investing from gaining more traction in the hedge fund space. Hedge funds don't always want other market participants to know what's in their short book, and this tendency towards being more opaque isn't necessarily that compatible with ESG, which obviously there's expectations around disclosure and transparency to ensure that investors have as much information as possible to be able to make informed decisions about ESG products. And in fact, just recently we saw some hedge funds actually pushing the FCA to roll back short selling disclosure rules. So in summary, I think it's a combination of some of the complexities and then the challenges of integrating ESG in the alternative space, but also some of the historical tendency towards being less transparent. But I think what we've seen recently is quite interesting in terms of developments around hedge funds starting to be brought into the picture more. And I think this is just part of the natural evolution as the ESG space matures and develops over time.
Yeah, so as you touched on it there, I mean, there are quite a few things holding back the hedge funds from being considered sustainable, even if they feel that they're making an impact. But this is changing. And what do you think is driving the traction in this space?
Yeah, so I think this is a really good question. I think that there are multiple drivers, so I'll just try and highlight some of the ones which I think are key. So firstly, investor demand for ESG alternative products have definitely been a driver. Some investors, particularly in Europe, have set targets and goals around their allocation to ESG products. particularly SFDR classified products like Article 8 and Article 9. And most ESG investors, they still want to have exposure to different investment styles and asset classes. And they don't want to be only restricted to investing in long only, for example. They want to be able to invest in alternative strategies, long-short strategies, systematic, multi-asset, etc. So I think the diversification benefits for ESG investors, which arise from integrating ESG into alternatives, is really, really key. And I think particularly the last 24 months where we've seen the turmoil in terms of energy and then also the banking mini crisis, I think all of this has really demonstrated the importance of diversification for ESG investors. Then I think there's also been a push from a regulatory and standard setting perspective. Regulators are incentivised to look into this space due to potential greenwashing concerns and also potential agency problems. Just recently, a report was published which basically found that hedge fund signatories to the UN PRIs, the United Nations Principles of Responsible Investment, benefit from greater investment flows. They're able to maintain higher assets under management, and this in turn can help them generate higher fee revenues. So without proper regulation or oversight, you could argue that there are incentives for hedge funds to essentially greenwash and overstate the ESG work that they're doing so that they can benefit from being involved in these ESG initiatives. And greenwashing obviously isn't always intentional as well. Without proper oversight, hedge funds' activities could potentially, the ESG activities could potentially mislead investors, particularly if they're not being fully transparent or not providing full disclosure around complex derivative instruments. You can imagine a scenario where this might potentially mislead investors in terms of the true real-world impact the strategy's having. So we've got investor demand, also regulatory tailwinds, and then I think finally another driver links to the growth that we've seen in firm-level initiatives like the Net Zero Asset Managers Initiative, for example. When firms sign up to things like the Net Zero Asset Managers Initiative, there's a requirement to set firm-wide targets. So alternative managers need to be able to apply net zero concepts in order to be able to set credible net zero targets and then disclose and monitor their progress with these targets. So this really drives the need for more industry guidance and frameworks on ESG more broadly, but also on quite specific areas like how you calculate the emissions for long-short portfolios, for example. And without proper guidance and consistency, alternative managers are going to really struggle to design and implement net zero strategies.
So is regulation doing anything to sort of crack down on this greenwashing? We've seen it in the sort of broader financial services. We've seen SFDR, SDR. What are they doing for alternatives?
Yeah, so my colleague Jason Mitchell has actually recently published a paper which provides a regulatory review of calculating the ESG impact for hedge funds. So I'd definitely recommend reading that for more of a deep dive into these issues, and that's available via the Journal of Impact and ESG Investing.
We'll also put a link in the bio for this podcast, so you can find it there.
But to give more of a high-level summary, so I think that regulation is definitely starting to look into this, and they're starting to provide some guidance, but it's not that comprehensive yet. I think that regulators have historically held back due to some of the complexities that I spoke about before, but also because of some of the polarising views within the market about some of these issues. So I think what regulators are doing is they're really waiting to hear the arguments from the various market players, and they're being quite patient, they're listening and they're kind of gathering feedback. And they're definitely proceeding with caution, mainly on a principles-based approach with some exceptions. And to give an example of one of the more contentious points, so just last year there was a debate around short selling, specifically in the context of net zero targets and whether you can net emissions for long-short portfolios. And this debate provoked views from a number of alternative managers, including Man Group, but also asset owners, data providers like MSCI and ISS. and then initiatives too, like the IIGCC, so the Institutional Investors Group on Climate Change. But ultimately, I think debates like this are really healthy and are necessary in terms of informing regulation and driving things forward. And that's a bit of a background in terms of the regulatory environment, but in terms of some of the specific regulatory developments that we've seen, so we've seen developments from an EU perspective with regards to the EU Sustainable Finance Disclosure Regulation, SFDR, and then also the UK's Sustainable Disclosure Requirements, SDR, on both short selling and derivatives.
Yeah.
So on SFDR, SFDR has recently published guidance on short selling, and their guidance is that for the principal adverse impacts, the PAIs, the PAIs of long-short positions should be netted at the level of the individual security without going below zero. So this is on a same-name, single-issuer basis, and it's really important to highlight that this contrasts with the traditional investment risk view of netting, which is where you net the total long exposure across all securities against the total short exposure, whereas for SFDR it's specifically just the same name exposure you might have on either side. And this SFDR guidance aligns with the EU taxonomy. And I think this is quite interesting because when you think about it, the SFDR's PAIs are impact focused, whereas the taxonomy is risk focused. So it's slightly surprising that the guidance at this stage is exactly the same. Then for derivatives, so for SFDR, there's now guidance on derivatives, namely to include derivative exposure for PAIs and then to net derivative exposure like for short selling. Then for the EU taxonomy, Man Group was actually part of the European Commission Sub-Working Group 5, which was examining derivatives, so we were involved in these conversations. But we probably won't see final determination on derivatives for the taxonomy until 2024 at the earliest. So then moving on to the UK's SDR, the FCA have been quite explicit in recognising the role that hedge funds can play and are actively seeking to not disadvantage different investment strategies or asset classes within the SDR framework.
Yeah.
And their initial comments point to a more transparency, disclosure-driven approach rather than a prescriptive one. So, for example, the FCA asked firms to explain how short selling aligns with a product sustainability objective, but at the moment they're not saying how participants should think about it. So I think it will be quite interesting to see how the FCA guidance evolves going forward. In a recent episode of Man Group's Sustainable Future podcast, FCA Director of ESG, Sasha Sudan, actually made comments suggesting that hedge funds will likely be expected to provide transparency through sustainability metrics that are distinct from economic risk metrics. And I think that's quite an interesting indication in terms of where things may go. But yeah, at the moment it's still very much a work in progress in terms of specific requirements.
Brilliant, thank you. That's a really helpful overview, and I do recommend that podcast to all of our listeners. Sort of regulation aside, the sort of question that we have at the headline of this podcast is, how can these financial mechanisms work to push forward sustainability?
Yes, I think that's another really good question, and there's obviously been a lot of ongoing debate within the industry about some of these points. If we start with shorting, the typical channels of influence linked to short selling include increased exposure to ESG themes, because you can have exposure through your short positions and not just on the long book. Also signalling a negative view of a company's ESG impacts or risks. So this could be viewed as a form of indirect engagement by letting or making company management aware of what the short selling community thinks. Another common argument is that by short selling you can increase a company's cost of capital, so the cost of capital argument. And conceptually this all seems to make sense, at least to me anyway, but in the real world these channels of influence could be impacted by several things, and these nuances are actually really important. So just to give a couple of examples, firstly, the ability of shorting to increase the cost of capital could be limited by several factors. Mm-hmm. In particular, the time varying or temporal nature of shorting. Yeah. So what do I mean by this? Shorting is not equivalent to divestment, which represents a long-term structural exit from capital. Yeah. and an investor might buy back a position or cover their short, which actually reverses the cost of capital flow, and it could actually reduce the funding cost for the company, so have the opposite effect. We might see this even more with discretionary long-short managers. We've actually looked at some internal data on this, which suggests that there might be higher turnover on the short book than the long book. Active engagement is another widely recognised approach to influencing corporate ESG behaviour, but engagement is nearly always expressed through long positions and not short positions. And there's also a lack of alignment, because when you think about it, being short position means an investor loses out if an engagement activity is successful and it results in the company improving, and then this is then reflected in asset prices. So there aren't necessarily the same incentives there to actually meaningfully engage on the short side. But all of this is not to say that there are no mechanisms by which short selling can have an impact. It's just that there are potential limitations and nuances in practice which investors should be aware of. And context is also really important here, I should say, whether you're looking at this through an impact or a risk lens. So I've been mainly speaking about this through the lens of impact, but if we think about this from a risk perspective, short selling definitely has the potential to reward investors for identifying ESG risks, like carbon risks, that have been mispriced by the market. Then on derivatives, so the role of derivatives in sustainable finance gained momentum a couple of years ago when ISDA, the International Swaps and Derivatives Association, published a report which provided an overview of ESG derivatives, and they found a number of things. So they found that derivatives can help firms hedge ESG risks. They can also facilitate price discovery and market efficiency. The ISDA report also found that certain ESG-linked derivatives, so this is not just generic derivatives, but ESG-related equity indices, for example, could help raise capital and contribute towards the transition to a lower carbon economy. But as with shorting, there are limitations. So a key one being with derivatives, if you have exposure to, say, an equity via a swap rather than holding the underlying asset, you lose your voting right. So this impacts your ability to be able to engage with the company. And then a slightly different point, but accountability is another key question in ESG that persists with derivatives. Specifically with net zero, and how should we think about the accountability associated with the emissions of the underlying asset? In my opinion, I think it doesn't feel right to just ignore derivative exposure in the absence of guidance, because otherwise you could get situations where managers just switch their exposure to derivatives and say that they've artificially reduced their emissions.
Of course.
So it doesn't feel like a very credible approach to take, but there is still a persistent lack of clarity in how we should deal with these things.
Thank you, Jess. That's really interesting. Obviously, we've talked about sort of the limitations, but as well as the real opportunities that come with these financial mechanisms. While these standards and frameworks are developing, what do alternatives need, both from regulation, from the industry?
Yeah, so I think from the alternative manager's perspective, I think in the absence of guidance, what we should be doing is disclosing methodologies and being as transparent as possible in reporting. So, for example, with short selling, reporting long, short and net emissions to give investors full transparency. So I think that's what managers can do. I think what we need from the industry is for standards and guidance to develop to help inform our approaches, particularly for things like net zero, where a lot of the guidance at the moment is very specifically focused on long-only corporate equity and bond type strategies. And we really need that guidance to inform us and allow us to be able to design and implement credible net zero strategies, and also to help investors be able to compare different alternative asset managers' strategies and the targets that they're setting.
Brilliant. Well, thank you so much for joining me, Jess.
Thanks so much, Sally. I really enjoyed it.
back in a few weeks with another episode of the UK SIF Leadership Podcast. Keep an eye out on our Twitter at UK SIF for updates. But in the meantime, I hope we will see many of you at our Alternative Investment Week next week. Please follow us and rate us on whichever platform you're using. See you next time.